Hello everyone. I've got two mics here, but I'll let the sound guys decide which of the two I'll be using. So yes, thanks for the introduction, Sasha. I'm Pierre, Verster, manager of the Protea range of hedge funds at Fairtree Capital. And basically, my job every day is to sit in a quiet space, read everything I can, think about it, and then hopefully make good decisions when it comes to investments. And I'm not a political analyst, and I don't have particular insights into the land question, but I do read what is going on in that regard. And it's been fascinating this week to hear what Magda has had to say on the local front, and then Ralph Matseka as well, who unfortunately couldn't be here today, which also gave me some additional insights into how to look at the land question and understand the difference between what politicians say and sometimes what they mean, and the intricacies of some of the challenges that they themselves have, and that Cyril Ramaphosa in this case specifically has, in dealing with slight margins of power and needing to balance that to get the outcome that they want. And it was good to read today, for instance, that in Northwest with Supra Mahumapela, that Cyril sort of targeted as the first of the Premier League to hopefully dislodge from his position, that it seems like the next Premier from the Northwest is going to be someone closely aligned to Cyril. So it seems like we're winning the fight, but obviously reading all these headlines about land expropriation without compensation makes one very nervous. And we read these things and we need to make investment decisions based thereon. And on that point, when we read information, we obviously have a perception. And in that perception, that informs what our decision making is going to be. So the first point to touch on is on perceptions. Now, I came across the Ipsos Perils of Perception survey in 2017, where Ipsos went to 38 different countries and chose 1,000 random people and did a survey, asked them a bunch of questions. Questions like, what do you think is the prevalence of teen pregnancy in your country? How many cars per capita do you think there are in your country? How often do you think a terrorist event happens in your country? Things like that. And basically, they collate those 1,000 answers that they get, but they also know the real answer. They have the factual answer as well. So they know how accurate people's perceptions are in terms of this survey. And when Ipsos ranked the different countries in terms of how accurate the perceptions are, South Africa was last, which implies that we're not very good at perceiving reality, and perhaps we sometimes get a bit too negative. So with that in mind, one must ask yourself, is the glass half full? Is it half empty? Well, if you're pragmatic, you would say maybe it's both. It's half full and half empty. And especially in the context of the political shenanigans happening, on the one hand, one should be optimistic, one should hope for the best, but on the other, one should also prepare if that isn't the outcome. It's a bit like when I got here, I drove here, and I'd still put on my seatbelt. I didn't expect to crash, but you still put on your seatbelt in case you do, with as low a probability as possible, get in that situation, and you do crash, that the seatbelt is there. So I take a similar approach to the land issue and other issues in South Africa to say, we hope for the best, but we plan for the worst. And we think the worst is a very low probability event, but it doesn't mean we're going to be naive about it. Now, stock markets are driven by two major emotions, greed and fear. And every transaction that happens on the stock exchange is actually where a person, a buyer, is willing to pay a price because they're greedy. They think the price is going to go up from there. But at the same time, there's a seller, someone who agrees at the same price to sell, which means they are a bit fearful. They think the price is going to go down. And that's what makes markets. So markets are driven by emotion. And for us to make the right decision, to have the right perception about reality, we need to master these emotions and not get too carried away either way. So that is why I say, don't be too optimistic, don't be too pessimistic, but be pragmatic about it. And in terms of being pragmatic, making the right decision, I can use the analogy of a mental toolbox. We should all have a mental toolbox with as many tools as possible to allow us to make the right decisions. Because, as the analogy goes, to a man with a hammer, every problem looks like a nail. And the major problem, which Glenn highlighted in his presentation, is people decide, should I stay invested in the stock market or should I move into cash? And that, for most people, is the only decision that they feel they should make. And as Glenn showed, most people make the wrong decision when they decide to move out of the stock market, because it's almost impossible to make two of the right decisions to know when to move back into the stock market. And that is the problem, that if you only have the tool of saying, should I be in or should I be out, that you make the wrong decision. So what I'm going to do is I'm going to be discussing 4 investment strategies to grow and protect your wealth. And those strategies are almost like extra tools for your mental toolbox, to allow you to think of investments not just in terms of should I be invested or not, but to think about some other options at your disposal, or some other options of investment funds that they employ, but through your financial advisor, or if you decide how to invest, you could consider these tools and these strategies to grow and protect your own wealth. Now, the first one of these strategies is activism. Activism is something that has happened a lot in international markets. These gentlemen are Daniel Loeb, Bill Ackman, and Carl Icahn. They are well-known activist investors in the US. Now, they're quite aggressive, but activism actually has got different levels of activism. You get these very aggressive type A males that go out and buy a big chunk of a company and fire the board and change the CEO and sell big divisions and try to create value that way by shaking up the company, and that is the investment strategy. Now, you do get other levels of activism, sometimes more behind the scenes, and we do have some of that in South Africa. There have been a few examples on our local market where we've heard about state capture, but there's almost been private sector capture, where certain companies had people placed on their boards, also made some strange decisions, and the shareholders behind the scenes needed to get involved and made sure that those people were removed from the board, that we don't have what happened with state capture in the private sector world. So we do have activism in South Africa, but there is space for maybe some more money being allocated to activist investors. So most activists first do their work in private, engaging with the CEO and the board behind closed doors, and only later do they do it quite publicly. But you need a big stick for this. You need a lot of money. You need to be able to buy a big chunk of a company so that if the board doesn't listen to you, you can effectively have so much of a shareholding, so much of a vote that you can change people on the board, and through that, change the people, change the CEO, change the strategy of the company. Now, there are some examples of companies in South Africa doing this already. There's one company that is currently involved in Altron, AdCorp, PPC, African Phoenix, and Novus. And there's another smaller activist fund in South Africa that is active in Stella Capital, Centova, and Rolfs. There is a risk to this strategy, though, and that is the risk of short-termism. So quite often, an activist would try to make changes, but just for a short-term boost of profitability, maybe for a year or two. Try and get the earnings per share to be as high as possible, sell out if the share price follows that, and move on. But that doesn't in itself create a lot of value for the shareholders that stay behind. So keep that in mind if you are considering allocating money to an activist strategy. The second strategy is shorting. Now, let me first make sure everyone knows what shorting is. Let's take shorting is you borrow shares and you sell it in the market, and through that, you make money when share prices fall. So let me use the analogy of gold. Let's say you think gold is going to be lower a year from now, the rand gold price, than it is today. How can you make money from that? Well, you can go to your neighbor and you can borrow some Kruger coins. And let's say at the moment, Kruger coins sell for 20,000 Rand a coin, and your view is the price is going to be low in future. You borrow those coins from your neighbor and you tell him, don't worry, I promise I'll give them back in a year's time. Maybe you pay a little bit of interest, and you take his coins and you go sell it in the market at 20,000 Rand per Kruger coin. A year later, one of two things can happen. Either the price of a Kruger coin is above 20,000 or below 20,000. So if it is below 20,000, say 15,000, you buy them back at 15,000 Rand per Kruger coin. You give your neighbor back his Kruger coins, and you sold them a year before at 20,000 Rand, but you bought them back at 15,000 Rand. So effectively, you've pocketed 5,000 Rand per Kruger coin. Now, the second scenario is the price of a Kruger coin is not below 20,000 Rand a year later, but above, say 25,000. In that scenario, you sold them the previous year at 20,000 Rand, but you buy them back at, say, 25,000 Rand per Kruger coin. Now you're out of pocket 5,000 Rand per Kruger coin. So shorting is a higher risk strategy. It's not normally employed in most unit trusts, but it is employed in hedge funds. And hedge funds themselves have been, for the last 2 or 3 years, regulated in South Africa in a regulated fund, where the fund manager needs to be regulated as well to ensure that even though it's higher risk, it is people with the necessary skills that employ this strategy. Not all shorts go to zero. And that is something that the media quite like to focus on when they hear there's a short interest in a share. Oh, is the share going to go to zero? Most shorts are actually as part of a risk management strategy that a hedge fund manager would employ. So for instance, in some of the funds that I manage, I'm short a portfolio of shares, 10, 20, 25 shares in different sectors, and not because I think they're all going to go to zero, but to manage risk. Let's say, for instance, in the retail sector, I could decide to be long ShopRite and short Pick n Pay, not with a view on what the retail sector will do, but just thinking that the one will do better than the other. The best shorts, though, are fads, frauds, and failures. And here is a list of the worst performing shares on the JSE over the last year. And some of them fall into that category. For instance, Steinhoff is down by 98% over the last year, which is a very sad state of affairs. A lot of people have lost a lot of money, and it seems like there's fraud involved there. So if you were long Steinhoff, if you owned Steinhoff, you lost 98% on that investment. But if you employed a shorting strategy, or at least invested in a fund that employed a shorting strategy, you could have made a profit rather than a loss from what happened at Steinhoff, and similarly with those other companies of the last year. Now, there is a risk with this strategy as well. It's called short and distort. Some of you might know that I'm also on the board of Capitec, chairman of the audit committee. And earlier this year, we had in the news a company called Viceroy come out with a report and saying, Capitec's books are cooked. There aren't sufficient provisions. The Reserve Bank should place them under curatorship. And they made a big song and a dance out of that. And that, I would say, is a short and distort strategy, where someone says something very publicly, but it's not based on truth and fact. It's based on misinformation and taking part fact, part fiction, mixing the two to confuse people, and coming out with a report and trying to drive down the share price after they had shorted it. Now, shorting is a legitimate investment strategy, but coming out publicly with misinformation is not. So just be aware of the risk of short and distort when it comes to shorting. The third strategy that one could consider is quants, quantitative analysis, or a quantitative way of managing money. It's quite a big industry abroad. Over $1 trillion has been invested in this strategy with a very good track record. Now, a lot of people think that the best investor in the world is Warren Buffett. But actually, there's a gentleman called Jim Simons of Renaissance Technologies, which runs the Medallion Fund. Now, the fund isn't open to the public anymore. He and his employees have actually kicked everyone out of the fund, and they only manage their own money now. But that fund has compounded returns at more than 35% per annum for more than 20 years. Better than Warren Buffett or any other investor. And it's a bunch of scientists that have created an algorithm, a quantitative strategy, looking for small discrepancies in share prices, looking for correlations across different assets around the world, and the machine making the decision in line with how these funds work. It's part of the fourth industrial revolution that Magda also referred to. Remember, the first industrial revolution was the steam engine, when we had some automation for the first time. The second one was the internal combustion engine, and what that meant for automating things, including the what did Ford have? The line, the automation of the line making Model T Fords. The third industrial revolution was the silicon chip and networks, when we had the internet and machines being able to communicate with each other. And the fourth industrial revolution is where these machines can actually make the decision themselves. They are intelligent machines, and with robotics and algorithms, they can replace humans, not just assist humans. Now, there's always a risk with that. Obviously, there's a risk to human beings because with automation comes job losses, but it also comes at a lower cost. So that's the benefit from the investment side. Most funds like smart beta funds or other quantitative funds are low in cost because of the use of machines rather than highly paid analysts. And the other benefit of this strategy is it avoids human bias. I referred to greed and fear earlier. A machine doesn't get greedy, doesn't get fearful. It follows the algorithm, and that's one benefit, not to make emotional decisions. So it has really improved the efficiency of markets, but at the same time, one must remember that these machines still trade based on signals. The algorithm has got an input and has an output. And if more and more money gets allocated to this, they're following the same signals to a large extent. So as an example, let's say the algorithm shows that in the past, every time that interest rates moved higher, property prices move lower. So now we've had higher interest rates. What does the machine say? Sell all the property stocks. But if all the machines do that, property stocks will get so cheap that then it's actually a buy. So quantitative way of investing is working right now, but if too much money goes there and all the quants, all the algorithms follow the same signals, it's actually the best thing to do is the opposite of what the quants would say. So it's working for now with $1 trillion, but we need to be aware of the risk to this strategy as well. And then the fourth one is to go global. South Africa only represents 1% of the worldwide listed market cap, if you look at all the markets around the world, 1%. And a lot of studies have shown that for South African investors, roughly half your money should be invested internationally to get a good risk-return payoff. While because of Regulation 28 and other reasons, South Africans generally are quite insular in their approach and they don't allocate as much internationally. There are different ways to manage money or to send your money or invest it internationally. The first one is with foreign investment allowance, the FIA money. So you literally apply to the Reserve Bank. There's a 10 million rand annual limit. You take the money offshore and you buy your shares or your fund directly. One of the risks of that or the downfalls is, for instance, if you pass away and you had assets in the UK with money you took abroad, there's estate duty on that. So there are some complications when it comes to taking money offshore through foreign investment allowance. Then there's asset swap, where your local institution can help you using their own allowance to get exposure internationally, but at least you're not exposed to these estate duty or other issues because it's effectively on the balance sheet of the big institution. And then you get a lot of localized funds, South African domiciled unit trusts and other funds that invest internationally, but you don't need foreign investment allowance, there are no limits, and it's a fund that's almost like any other local fund that you can access, but it invests internationally. So different ways for you to get more exposure to global stock markets. It does sound like a leap to go from where most people are right now. In terms of Regulation 28, most pension funds are below 20% in terms of their offshore exposure, to go closer to 50%. But if you think about it, the JSE as it is today, if you look at all the revenues of all the companies that are listed on the JSE and where they generate those revenues, more than 2/3 are generated offshore already. So the JSE is quite a global stock market. We've got a big brewer, a big tobacco company, a big luxury goods company, a bunch of global miners. So to say we should go international and go global isn't such a big step. We're just saying, rather than just looking at British American Tobacco, what about the other tobacco stocks? What about the other luxury goods stocks excluding Richemont? Or the other beverages stocks excluding Anheuser-Busch? So it's not such a big leap. And a lot of people think you should be in New York or London in order for you to manage money internationally. But we've got a major fund manager doing it from Cape Town with a global emerging market franchise. We have a major asset manager with South African roots doing it from Bermuda, in a island in the middle of nowhere. I pick stocks from Germiston on the east rand of Johannesburg. So these days with technology, you can literally sit anywhere and still analyze companies internationally. And in the US, they have Regulation FD, Fair Disclosure, which means that small meetings that analysts have with management teams, maybe in the past they could wink and say something that the general public doesn't know and the analysts would make the right decision in terms of the prospects of the company. That can't happen anymore. We all have equal access to information, whether you sit in South Africa or in London or New York. So it really has opened up the world through technology to be able to invest all over the world. So to summarize, those are 4 investment strategies you could consider if you want to protect your wealth and turn this threat of land appropriation without compensation and other political threats into opportunities. Don't just think in terms of, should I be invested or not? Think about the other tools you could use in your financial toolbox and consider activism, shorting, quants, and going global. Thank you.